Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Wednesday, December 28th, and then we'll see how things look for Thursday, December 29th. We had another down day. Our technicals were already pointing down, and so it's not necessarily a surprise based on what we're seeing within our charts, but we're into this period that can be considered positive seasonality with the Santa Claus rally. That's just not happening. We had a down day on Tuesday. We had a more significant down day on Wednesday. We're getting to the point where we might have overdone it a little bit in the short term, going down a little too far too fast. It doesn't mean we have to stop here, but it might mean that we bounce a little bit more sideways. We could see an attempt at a recovery bounce to try to take prices back higher, but our picture overall is still decidedly negative. One thing to point out to you is on January 7th, there will be a free webinar. I have no connection with this. I'm just going to be participating in this webinar as well, just to give you some insight as to the outlook for 2023. If you want, you can attend this. It's Saturday and it's on January 7th, and it starts at 9 a.m. Eastern time. You'll have to adjust that for different time zones. It's free. You only have to supply your name and your email address, and so feel free to sign up for that if that's something you might find helpful. I am already signed up. I will be attending. We'll see if we get any useful information from this that I can then share with you for analysis and commentary. All right, let's go back and talk about what happened right at the open. We did have a higher open. Things started off on a positive note. We went all the way up to R1 at 38.46. After that, we fell. We went down below the daily pivot and the unchanged level, which were just about overlapping each other. Prices then fell all the way down to S1 at 38.13, and we actually went below S2 at 37.96. So we broke through that 3,800 level. The important thing is, we went below 3,800, but could we get back and close above that? Well, that really didn't happen. Prices did attempt to rebound. They came back above S1, but then fell back to make a new intraday low. At first, it looked like this rebound had some real strength behind it, but it quickly fizzled out and we turned and went down even lower. We closed almost at the low for the session. We were down 1.2%. And volume is still below average, and it declined from Tuesday's pace because we're still in holiday mode. That's pretty common between Christmas and New Year's to see things really slow down. The technicals, as I stated, are still decidedly negative. Pretty much everything we have is pointing down, and the markets are really fixated on this inflation and interest rate scenario that the Fed will have to keep raising interest rates. Inflation is still a real problem, even though it's coming down. It's higher than it's been in a long time. You have a whole generation of money managers and hedge fund managers and those that supply investment advice who've never been through anything like this. They've never seen inflation this high, and they're not quite sure how to do this. They think they have a handle on things, but they haven't had a lot of experience behind them to really understand what's going on, and that's producing some real fears in the market. All right, here's the intraday chart showing how we did have a higher open. We went all the way up to R1, stopped right there, turned around, came down below the daily pivot and the unchanged level, went negative, broke through S1, came down, even broke through S2. And this was the rebound. That it looked like this was really going to do something, and it started off pretty good. And we went back up to S1, but then we just fizzled out and drifted back down sideways and then lower, going into the closing pretty much at the low for the day, just a little bit off of that. One thing to be aware of, that the charts that I update every day, I post them on the community tab. There's an intraday pivot point chart and a daily pivot point chart that I update. And the daily pivot points are good for the whole month. I just update it with the latest price action. And some of you might find that helpful. All right, let's talk about what happened. We're still in this period that's considered to be the Santa Claus rally period of time. And that's the last 5 trading days of the year, and then the first 2 trading days of the next year. We're in that right now, but it doesn't seem to really be happening yet. And that's kind of indicative of what it's been like in 2022. We get some good news. We have some positive seasonality. We look at historical norms of what's happened before. And it's like, okay, we have a shot at going higher at this point, and that may last for a day or two or even a few days. And then it quickly fizzles out and we lose that and then tend to drop even lower. There have been things from the Fed that have been planted in the Wall Street Journal that supposedly marked a kind of a pivot, but then Chairman Powell comes out and pretty much wipes all that out. And so you have a real confused market that is learning the hard way not to fight the Fed. When we're in a rising interest rate environment, we have to respect that, understanding that there's a reason why interest rates are going up and possibly earnings are coming down, and that has an impact on stock prices. All right. Then another thing that I did state yesterday, and I'll keep this up until this actually happens, China will end the quarantine requirements for international travelers, and that will start on January 8th. Also, this is being lessened with the people in China as well. So they're experiencing a bit more freedom and not as much of strong lockdowns. But that also means that a lot of people are getting sick right now with the Omicron virus. The S&P did lose the 3,800 level. That's more of a psychological thing. It's a round number. The financial media likes to point that out. It's easy to talk about. And it had become kind of important because we came down and tested that level a number of times. Well, we actually dropped and closed below that in Wednesday's session. The VIX is still acting pretty strange. It's not really spiking up as we're going down. But another thing that's really spiking up again is the equity put call ratio. And I have some charts to show you. The concern here is the earnings per share for each individual company, and then the valuation of that company or of an index or of the entire stock market. It's still considered by a lot to be expensive, and so that justifies prices going lower. The dollar was up a little bit, and that usually provides a headwind to stocks, as well as interest rates were also up, which typically will provide a headwind as well. We're not seeing a real direct, well, there is a correlation, but it's not a real strong inverse relationship right now. The markets are not fixated on the dollar or on interest rates. They're just going down, mainly because of earnings concerns. On the short term, we have the PMO studies that are getting extreme negative, the Stochh RSI and the Williams percent are. This happened after Tuesday's session. It became even more so after Wednesday's session. And I don't have charts of the Stochh RSI and the Williams percent are. They're pretty touchy. I will show you the PMO studies. Nothing in the intermediate term yet is even showing up right now. As far as our inverted yield curves, the 30 to the 5 has switched back to more of a normal stance now. We've seen that happen before, only to have it go back inverted. So I'm keeping this on the list for right now. The 30 to the 5 is not a real biggie. The market really pays attention to the 10 to the 2 year and then the 10 to the 3 month. Those are the real important ones that have a tendency to signal once they're inverted, looking forward, there's a likelihood of a recession. But we've been monitoring a lot of different yield curves for quite a while now, and the 30 to the 5 is on our list. Our sentiment is still negative. If we have another down day and if fear continues to increase, we'll get over into the extreme area. We're at about 31 or so now. But while it's at this point of not being extreme, we tend to follow that and go with it. And so that is also suggesting that things are more negative. The economic reports that came out, pending home sales, more weakness in the home sector. They were down 4%, much less, or much greater, I should say, than the expected down 0.2%. Wow, that was quite a bit more weak. The last time we had this, we were down 4.6%. Our trend is negative and it's starting to turn up. Now that things are switching a little more negative, we saw more of a thrust to the downside in Wednesday's session. So it's starting to strengthen. We're just barely getting above that moving average. Now, some of you that are a little more aggressive, we're in a downtrend right now, and you may want to say, okay, I'm treating that as a downward trend right now, even though we're still below 20. Usually 20 marks the line between trending and non-trending. So just be aware of that. Some of others may want to wait until there's more confirmation of what's actually happening, or we actually get above 20 with that. But we're quite a ways under 20 right now. Our bias continues, or it is negative. I switched that over from mixed. And momentum, I'm still keeping mixed. A lot of that has to do with the low volume that we're seeing. If we have another down day, the momentum will probably get changed over to negative. If we're up, we'll just have to evaluate things at that point. All right, here is the model that the market might be following. Going back to from 2006 through 2008, that's the green line here. And we've been pretty close to what's been happening in that same time period. And we just put the S&P, the current values, over top of this. This suggests that we could be in for some weakness if we stick to this same basic model of what happened before. And right now, that seems more likely. Also, the VIX, which really is not spiking up, but if we really start to drop, we would see the VIX really start to go up, but it's just not doing that yet. Here is the VIX to the S&P correlation, and this is acting kind of strange. We don't see this very often. I don't know why it's changing here, but we didn't really add to this after Wednesday's session, but to see this spiking up is not really common. The red lines on here just show where we had a pretty extreme reading with this, and then typically, not always, but usually what happened after that is a short to intermediate term decline in the S&P if you compare it with what happened down below. We're not really using this as a signal yet. It's when it gets way up high, that's when we look to see what's happening at that time, and will that suggest a negative S&P 500 going forward, at least for the short to intermediate term. Here's our Ulcer Index starting to go back up as we're dropping. Fear is becoming greater. And here's the equity put call ratio. My goodness, look at this one-day spike, just way up here. That is massive. And then here's our 5-day, which we thought the spike before was big. Well, look at where it's headed to now. That's pretty significant. And then here we're way up at the top right now with our 5-period simple moving average. And what we try to look for is a spike in the equity put call ratio, and then combine that with the downward thrust of price, and that often marks a bottom. Well, we're getting the big thrust, but we've just been chopping sideways for what appears to be the last week or two as we are around the holiday. And we're not really seeing that capitulation to the downside. We're just kind of, everybody's negative, but nobody's really freaking out massively as far as our charts are concerned, at least yet. And then we may have done it a little bit overboard in Wednesday's session, where the advanced decline ratio was extreme negative. So that might suggest things could slow down in Thursday's session. Here's our ADX, which measures our trend, and it's starting to come back above the moving average. If you're more aggressive, you might go with this. The red line is on top and advancing, so we are in a downtrend. But if you look at the chart pattern that we're dealing with here, we've broken down below this range that we've been in for the last number of days. We haven't exceeded the low set last week, but you might want to see that the confirmation is if we take out the low from Wednesday's session and then take out the low from last week, that might confirm more of this negative trend. The BPI, it actually ticked up a little bit. That's kind of strange for a down day. And we're just watching this closely. This helps us measure inside of the S&P 500 to see the general strength. And right now it's kind of holding up. To be down 1.2% and to have this tick up a little bit, that's kind of a divergence in a positive way right now. And then here's the PMO study showing that we're getting extreme negative with those PMOs that are rising. Those are all the PMOs in the S&P 500, and they're getting extreme negative. The buy signals have been extreme negative, and those that are above zero continues to decline. So it's negative, yes, but we might have overdone it slightly, at least in the short term. Here's our stochastics, also in the short term, showing that we're pretty extreme with the short, intermediate, and getting extreme with the long term. Please remember, this is a subdivision of the short term. So the short term, that's like 1 or 2 days. Intermediate term would be maybe a week or so, and then the long term might be 1 to 2 weeks. Here's our daily chart showing how we broke down below the pivot level. We're below both the 200 and the 50-period moving average, but we're still kind of in this range. If we get a bounce back up, it'll just suggest that we're going to continue to go sideways. If we really break down below this, then you might see selling pick up at that point. And then down at the bottom, we see where volume is below average, and it did decline from Tuesday's session. We're well below all of the moving averages now, and we've been below them for long enough. So some of these moving averages are starting to roll over, and that's more negative. New highs, new lows. Saw a little breakout in new highs, but also a breakout in the new lows. And so we continue to decline overall with our 5-period, and we're declining with the 10-period. The Elder Impulse, after spending a couple of days being neutral, it is now back to negative with a red bar. So that's negative too. The Swindlin Trading Oscillator, based on price, this had been holding up fairly well, but now it's starting to roll over based on price and volume. Our Ichimoku cloud, we're starting to break below this support level. And if we don't see any kind of a bounce in Thursday's session, or pretty quickly in Thursday or Friday's session, this could really suggest that this support is being broken. Our fib levels breaking down below this double fib retracement level from the August high to the October low and the September high to the October low. So in the short term, this is more negative, but we've been down here before. Can we get back above this, or are we going to continue to fall? Longer term, we're breaking down below this double fib level, going from the COVID low to the all-time high, and then a significant low that was set in 2021 to the all-time high, and that produced 2 overlapping fib retracement levels here. We're breaking down below that, so that it's just showing more deterioration. Unless we come back up and get back above this, we're in danger of continuing to fall. Weekly chart, we also came down below this 38.2% retracement level. We're still above the 200-week moving average. If we do keep falling, we'll be watching that. We're still a little ways away from that at 36.68. But if we start to come down, and if this doesn't hold, that's really going to shift things much more negative, because even as rough as 2022 has been, as we were coming down, this still held back in October. But if it breaks now, that would not be a good thing. Our trend channel shows that we're on the underside of the midpoint of the trend channel. The Dow, it did close down below its 50-period moving average, but it's still above the 200-day moving average. So this is still looking like a golden cross, but it may be a fake out if we continue to drop from here. And then silver also having a recent golden cross, even though it was down 2.31% in Wednesday's session, but it's pretty hard to find some trend with the precious metals. But I just wanted to point this out to you. All right, so our outlook then, the technicals are negative, and we're still wondering, is this Santa Claus rally going to happen? Well, our parade has been rained on as of this point, so, but anything can still happen going forward. We have weekly jobless claims coming out on Thursday, and that's it. And that can be kind of significant, but not a real big market mover in and of itself. And then the geopolitical events, with inflation and interest rates really being the fixation for the markets right now, And then things are in holiday mode, so we're seeing a lot less volume. So if something happens, if somebody freaks out about something, they can really push the market either way, either higher or lower, because there isn't as much of volume to counteract that right now. Our scenarios kind of going with the down one, especially if you're more aggressive with the ADX, because the technicals are negative, but we are short-term oversold, or at least in that area. It doesn't mean we have to stop, but a lot of the indicators that we use are getting extreme negative. Can't really go with the up scenario because everything's pointing down and we're wondering, is this rally even going to happen? Our positive scenarios, our sector rotation, our positive setups, they're just crumbling right now. They just continue to show weakness. And the technicals, as I said, are weak. We're losing moving averages and pivot levels, as well as fib retracements. Can we get those back, or are they going to provide overhead resistance if we even try to go up? So really, we're still going with the sideways trend unless you're a little more aggressive with the ADX, because it is strengthening. The ADX is. We're still below 20, though, and we are negative because the red line is on top. So our conclusion, the S&P is negative. In the short term, negative and becoming oversold. Intermediate term, just flat out negative. Long term, we continue to be negative as well. Thank you. Have a wonderful day on Thursday, and I will talk to you in the next video.